Markets breathe. They inhale during quiet consolidation and exhale in explosive trends. The Bollinger Band squeeze is one of the cleanest ways to detect that inhale, the moment when volatility compresses to a multi-month low and price is coiled for a directional move. Today, we'll dissect the math, the entry triggers, the exits, the false signals, and how to layer Confluence so you stop getting faked out at the breakout candle. Bollinger Bands plot a 20-period simple moving average with an upper and lower band set 2 standard deviations away. Standard deviation is volatility, so when realized volatility drops, the bands mechanically pinch toward the mean. The middle band is your trend reference. The outer bands are dynamic 2 sigma envelopes. Roughly 90% of price action stays inside, which means the bands themselves widen and contract as a real-time volatility gauge. A squeeze is not just narrow bands, it's bandwidth at a relative extreme. Bandwidth equals upper minus lower, divided by the middle band. When that ratio drops to a 6-month low, you have a textbook squeeze. John Bollinger called this the lowest bandwidth in the last 125 bars. Some traders prefer the Keltner-based definition, where the Bollinger Bands sit entirely inside the Keltner channels. Both flag the same idea. Volatility is unsustainably low. The intuition is simple. Volatility mean reverts much more reliably than price. Extended quiet periods don't last because option sellers, market makers, and trend traders eventually force a repricing. So when bandwidth compresses to a percentile floor, you're not predicting direction, you're predicting that range will expand. That distinction is critical. The squeeze is a setup, not a signal. The breakout candle is the signal. Watch 3 things on the chart. First, the bands visibly pinch and run nearly parallel. Second, price coils into a tight range, often forming inside bars and overlapping bodies. Third, the bandwidth indicator hits a fresh local low. Importantly, the longer the squeeze persists, the larger the eventual expansion tends to be. A 2-week squeeze on the daily chart packs more potential energy than a 3-day squeeze on the same time frame. Here's the worked entry. You wait inside the squeeze, then enter on the first candle that closes outside the band on expanding range and above-average volume. Stop goes just beyond the opposite band or the squeeze midpoint. For aggressive traders, a break of the prior swing high or low inside the squeeze is enough. Conservative traders wait for a retest of the broken band as new support or resistance before committing capital. Exits are where most traders give back the move. 3 approaches work. First, trail with the opposite Bollinger Band, exiting when price closes back through the middle band. Second, scale out at a measured move equal to the height of the prior consolidation. Third, exit when bandwidth peaks and starts to contract, signaling the expansion phase is done. Avoid fixed profit targets here. The whole point of a squeeze trade is to capture the fat tail. The squeeze excels at 3 things. It objectively identifies low volatility regimes without subjective trendline drawing. It prepositions you ahead of momentum traders, so your risk-to-reward skews favorably. And it adapts dynamically to every instrument and time frame because standard deviation rescales automatically. You can run identical logic on a 5-minute futures chart and a weekly equity chart with no parameter tuning. Now the weaknesses. Squeezes are direction agnostic, so roughly 40% of breakouts reverse violently, a pattern Bollinger himself called the head fake. Bandwidth can also stay low for weeks while you wait, tying up attention and capital. And in choppy, news-driven markets, the band breakout fires repeatedly in both directions, generating whipsaw losses. The indicator tells you when to be ready, not which side to bet on. Combine the squeeze with directional filters. Volume is non-negotiable. A breakout without a volume surge is statistically a fade. Add a momentum oscillator like MACD or rate of change to confirm the breakout side. Higher timeframe trend alignment, using a 50 or 200 period moving average, dramatically improves win rate. And on balance, volume rising during the squeeze itself often pre-signals the breakout direction before price reveals it. Watch for momentum divergence during compression. If price is grinding sideways, but RSI is making higher lows inside the squeeze, the breakout odds skew bullish. The reverse is true for lower highs. This is one of the few times divergence is genuinely actionable, because the squeeze gives you a defined trigger event right after, rather than the open-ended timing problem divergence usually suffers from. Here's Apple on the daily over the past year. Notice the multi-week compressions where the bands collapse around price. Each time bandwidth hits a local floor, watch what follows, a directional expansion within days. Some breakouts hold, some fake out and reverse, which is exactly why you need volume and momentum confirmation. The pattern is repeatable, but never automatic. 3 mistakes ruin squeeze trades. 1. Entering during the squeeze itself rather than on the expansion candle, you'll bleed out in the chop. 2. Using tight fixed stops inside the bands, volatility is about to triple, so your stop must respect that. 3. Ignoring the broader context, a squeeze against a strong opposing trend on the higher time frame usually resolves with the trend, not the breakout direction. To recap, bandwidth at a multi-month low flags a squeeze, the breakout candle on expanding volume is your trigger, you trail with the opposite band or midline, and you confirm with momentum and trend confluence. Tomorrow, scan your watch list for the 5 tickers with the lowest current bandwidth and mark the levels. Don't trade them yet, just observe how they resolve. Pattern recognition is the real edge here. This is education, not financial advice. Manage your risk, and I'll see you in the next one. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.